The best way to beat the market in 2017 be buying assets that everyone thinks are overinflated. Talking about things, of course, like Bitcoin here. If you put all of these kind of bubblicious assets together in a hypothetical portfolio, you trounce the S&P, more than doubling what you put in at the beginning of the year. Of course, that's what bubbles tend to do. Tim Graf is still with us from State Street. Tim, is this just because they're bubbles and you expect them to burst soon, or are these momentum trades that we were talking about earlier really the way to go right now?
Well, for the long-term investor, I would suggest probably not. Momentum trades always come to an end, and as we talked about in the last segment, that is usually cut off by a tightening of monetary conditions. Particularly U.S. monetary conditions seem to be quite influential globally as far as volatility is concerned. And so the chart you've shown is for this year, where, of course, volatility has been low, correlation amongst and within asset classes has been declining, and that is your classic setup for momentum trade. But that is entirely predicated upon monetary policy remaining quite supportive, or if it is tightening, at least tightening in the very gradualist fashion, such as what we've seen from the Fed. Once that ends, once policy becomes quite tight, once real interest rates become positive and maybe sharply positive, then it all starts to unravel. And so for the long-term investor, they have to keep that in mind. For the short-term punter, it's probably okay, but it's not something that I would really pound the table about as a long-term investment strategy.